The word stagflation is being used more frequently to describe what's happening in the U.S. economy, and investors who recall the bout of stagflation in the 1970s are getting concerned at the market impact if we are indeed in a stagflationary environment. So, is the U.S. economy experiencing stagflation? Let's break it down. So let's first separate the stag from the flation. The stag refers to stagnation or stagnant growth. Now, it's true that we anticipate that the U.S. economy will slow down from the frankly unsustainable rate of 6.6% we experienced in the second quarter this year. The third quarter slowdown to just over 3% is driven by the surge in the Delta variant and the related business impacts, as well as the continued supply constraints that are impacting the ability of suppliers to fill orders. We view this as demand delayed and not destroyed. We continue to see high-frequency indicators of the economy reflecting demand at the consumer level for both goods and services. The backdrop for demand remains robust. Corporate balance sheets are very healthy. There remains a high level of household savings, and there's ample demand for labor with roughly 11 million job openings according to a recent survey. We anticipate strong growth as we end the year, and we expect some of the growth shortfall from the third quarter will also support healthy and above-trend growth in 2022. So as far as the stag part of stagflation goes, we disagree. So let's move to the flation, that is, inflation. It's obvious to all that we're in the midst of a much higher consumer price inflation relative to pre-COVID levels. While we anticipated higher inflation as the economy reopened and robust demand overwhelmed supply, we did not expect that it would last as long as it has and likely will. We do see higher inflation into mid-2022, but we anticipate that higher supply will meet slowing demand, leading to a more normalized inflation rate and perhaps even an eventual undershoot relative to the Fed's target. It's important also to look under the hood of inflation and at the drivers. And key to the higher inflation this year have been areas of the economy most impacted by the COVID shutdowns. A significant inflation tailwind this year has come from durable goods, new and used cars, furniture, household appliances, electronics. These goods have been impacted by the semiconductor shortages, Delta outbreaks across Asia, and logistical logjams. Industry experts continue to expect semiconductor shortages well into 2022. However, we appear to be past the peak of Delta infections across much of Asia, and while container rates are not exactly falling rapidly, we have seen a leveling off and even a modest decline over the last few weeks. So, on the inflation side, we do see upside pressures continuing for a while, but ultimately abating. So, on the stagflation debate, we come down in the no camp.